So, your trading's not working, what do you do? Hi, and welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
Each show, we cover your burning questions and cover all subjects from the world of trading.
Okay,
this week,
this is a question that you've had.
Yes.
Let's explore this.
So I got sent this question. So what do you do when your trading is not working, and how do you cope? So I thought it was really interesting because it throws up the initial idea of what do you mean by not working?
Yeah.
So could that be that you are losing money? In probably most cases, that's what is being implied. But could it be that you're flat and you haven't made any money, you're just breaking even for a period of time? Or could it even be that you are profitable, but you're not as profitable as you would like to be? So I think it's important. It's a very broad question. But if you are in that position where you feel like your trading is not working, the first thing would be to define what would working look like and what is not working actually mean. Because it's very easy to be hard on yourself, or it's very easy to be making a certain amount and it not be what you want. So if we take it from the point of view, let's assume that that person means they're losing, they're losing money. It's not working for them. Why? What do you do and how do you cope? So you brought up a really interesting point when we were talking earlier, which was the nature, the nature of human nature, essentially. So I think that would be a really good place to start.
Yeah, and I think you're right. Although it was a broad question, we've got to make the assumption that when someone says a question like that they're not making money. But it was a really good point that you said, that it could not necessarily be that. It could be that you're underperforming where you want to be, but you are profitable. But let's assume, yes, the trader is not profitable. And what I find interesting is this natural tendency of human beings to want to fix something. So, this isn't working, I need to fix it. And the thing with trading is sometimes there's nothing to fix. You actually might be doing all the right things, and you might have let's say this person's got a defined strategy, maybe mechanically trading. So let's go with that, and they're following it to the letter, and they've just, over a period of however long, 3 months, 6 months, whatever it might be, have overall either just their P&L is flat or maybe negative. But it doesn't mean that what they're doing is wrong, or necessarily even that the strategy's wrong. But as humans, we're like, well, we've got to fix it. We've got to change something. And then the potential to then start curve fitting, thinking, right, well, if I tweak it here and I tweak it there, and then all you end up doing is you're now changing the strategy, which actually might actually be profitable. It's just gone through a drawdown period. So unless you go back, and you'll talk about this, back test and stuff, then you don't know. So he's got to be very careful there. Otherwise, he becomes a curve fitter / strategy hopper. So let's.
I think the idea of fixing things is really interesting, because what I notice is people will go about fixing things in different ways. So you might get a more analytical type personality who's going to sit there and delve into the data and look for a new indicator or a new exit system, or try and fiddle with something. But they've underestimated not just their want and desire to fix things, but also the fact that by nature we tend to think short term. So like you said, it might feel like a long time that the strategy isn't working or you're losing money, but it may only be a 3 or a 4 month period. Now, to a lot of new or semi-experienced traders, that's a lifetime, but to people with experience, that's nothing.
Yeah.
So I think that's an important thing to understand, is that you may well be trying to fix something over the short term, but be aware, like you said about curve fitting the strategy. A classic thing that analytical traders will do is they'll change the numbers. But actually, an important thing is, if you've got the data of historical performance on that strategy, is lean on that data. So look to see if there's been a period of time where the strategy has performed in a similar way. Because sometimes just 10 minutes of reviewing previous bad performing periods, because it could just be a random nature. They've just come in at that point where the strategy is underperforming. But if they can look back and get some perspective over a previous year, previous couple of years, they may simply realize that actually all they do need to do is sit it out. And other things I see is traders will, rather than necessarily go into the data and fix it, they may bring in another strategy. So greed will kick in, their desire to want to be profitable. So they'll maybe continue with that one, but bring in another system or another setup, or they'll over leverage. They'll think, well, they'll want that winning period so much that they'll double up on their risk, or they'll try and run the trades longer and they'll start fiddling around with it. So, or worst case scenario is they give up because they're thinking too short term.
Yeah, sorry.
No, carry on.
Yeah, just to add there, I do think that on this mechanical approach, so yes, have a look at the data if you're trading mechanically like that. But, and so it could be trading within the realms of historical performance, which is fine. But also, you've got to make sure that if you're trading mechanically, that there might not be anything wrong, but at the same time, it could well be that the mechanical strategy has come outside of historical norms, and it might well be that it's not going to perform in the future, because a lot of mechanical strategies are like that by nature. But a lot of the time, like you're saying, people jump too early and they're already moving on to the next strategy when this one may actually be fine and it's trading within its historical norms. You've just got to persevere with it, and you need to have that tenacity and perseverance to stick to your guns and develop that confidence in the approach that you're using.
Yeah, and I think there's a tendency when a trader comes out of a losing period, is to feel that sense of relief and go, oh, that's over now, and then they forget about it. And we always say is you want to really own that period, and you bank it or really hone in on that period, because it's going to happen again. And that's the difference, I think, is a lot of traders are doing everything they can to get out of a bad period, changing things, messing around with it. They get out of it, they feel better, and then they don't think, well, this is going to happen again, because actually it's an opportunity for that trader to firstly objectively look if they're doing everything correctly, and if they need to stick at it, they need to see it as a learning period. It's a chance for them to build up some emotional strength, so the next time it happens, they're better equipped. They're not going to like it. Nobody likes going through a drawdown period, but they're better equipped to go through it if they treat this experience as a learning process, rather than just being obsessed with the fact that they aren't making money at that point.
100%. As we always say, trading is all about mindset. It doesn't matter whether you're trading, we get people say, oh yes, but I'm using an EA or I'm automated my trading. Yeah, you may well be, but when it goes through a drawdown, it's still going to affect you and you're going to want to turn it off or whatever. So you're absolutely right. Most of trading is mental agility, mental strength. And unfortunately, most people don't develop that enough, because they're too obsessed with strategy and technique and when's my next trade and all of that, rather than, I always say what you've just said there, bottle that. So if you've just gone through a period of flat drawdown, whatever, like you just said, it's going to happen again in the future. You come out of it, but don't think, phew, that's it, that's done. That's never going to happen again, because it will do. It will, in a different guise, it will happen again at some point in the future. So bottle that whole experience, log it, screenshots of the sort of trades you were doing at that time, make notes galore, because then you can draw upon that experience in the future. And a lot of people don't do that because they forget it. And then in the future, they're a year down the line and it's happening again, and they're like, oh, I'm not happy with this. And they've forgotten, oh yeah, I've done this before.
Yes, they aren't able to draw on that experience.
Yeah.
Good. So, interesting question we got here. How much does intuition and gut feel play a part in your trading? We could talk about this for a long while.
Yeah.
So this is an interesting one, because we've just been talking about experience. So going through a period of drawdown, that's an experience point that you can bank or bottle, as you said. And I think so to answer, do I trade on gut feel? No. But do I have experience that I've built up over the years that I will bring to the table in a scenario where I may see the market in a certain way, and I may not consciously go, oh, that's like the time in 2011 when this happened, but I'm almost subconsciously drawing on all of the previous experiences I've had. Exactly. So I wouldn't say I trade on gut feel, but there are things that I will do that I'm sure are as a result of the experience, and there'll be certain decisions I will make that are based on experience that to somebody else might go, who's new, well, why are you doing that? Well, it's the build up of years and years of learning, essentially.
Yeah, and I think that gut feel, just to add to what you've just said there, from my perspective, it's the same. No, don't ever trade on gut feel, but you can still use it to a degree to help you, because sometimes the trades, and it's it's an old adage really, but the trades that you really don't want to take are the ones that end up being the best trades, the ones that feel the most pain at outset, that you really don't want to take it, and you've got that in your gut, it feels like, oh, this is, the setup's there, and you're taking your trade, but you just feel like, oh God, it might be that there's a load of news out. The whole news environment is very pessimistic. Let's take the stock markets for this year. That's a classic example. A lot of pessimism out there. Oh, there's recessions coming. Stock markets are going to go back down. And what's happened? They've just gone up and up and up. Well, so in the first half of the year. So, and that's a classic there, where you could be inundated with, swamped with information, which makes going long very painful, and actually it's the right decision.
Yes.
So in your gut you feel that way, but use it and utilize that, because many people will say, oh yeah, some of my best ever trades actually weren't that easy to take at outset.
I've got an example this year. One of my old trades, everything in the news was suggesting the opposite of what I wanted to do.
Right.
But in a way, at that point I went, oh, because this is making me feel awkward, I almost have, it's like, well, I'm almost now at the point where I'm like, no, this is going to be a good trade, because you've got used to that feeling of, actually, the ones that often feel that awkward, antsy feeling at the outset often end up being the best trades.
No, absolutely, yeah.
Good. And then, this is an interesting one. So, I've got a trend following strategy. Well, not me personally, but the question, I've got a trend following strategy that has a 33% win rate. What if I traded the reverse and did the opposite?
Yeah, this is a question that came in this week as well. And so this chap found a traditional sort of trend following approach type strategy with a 33% win rate, because it has bigger risk rewards, so naturally has a lower win rate. And he said, I've just thought, well, if I inverted that, so instead of buying when the buy signal comes in, if I sell, then I'll be right 67% of the time. And isn't that right, Charlie? And I'm like, it's not really that simple, because if you invert it, you've still got to put a stop loss in there for starters. So where you put your so the point where you would otherwise be buying and trying to run it, well, some of those will run up to some degree or another and then just roll over. So when you're selling at that point, well, you've still got to put a stop loss in. So some of them are just going to get stopped out, even if you were right.
Exactly.
And they're going to get stopped. They're going to get stopped out before it comes down. And where are you going to target? So that whole 67% win rate gets chucked out the window as soon as because you have to put a stop loss in it, and you also have to have a reward as well for your trade. So it's not as simple as just turn it upside down and just doing the opposite, because you've got to have stops and targets, and it may well be that it just can't work in reverse.
Yeah, I think it brings the wider issue that you see a lot with people in that sort of 0 to 1 year window, where they'll come up with this theory of, well, if I just do the opposite, or if I just don't have, they'll come up with something, and they're trying to fit a square peg in a round hole, essentially. If I just do the opposite, and it comes back to only thinking, one consequence. They're not thinking second, third, or fourth consequence, because they haven't got the experience. And what seems so obvious on paper, invariably, is
it's like they're trading in 2D.
Yes.
Not in 3D or beyond. So it's an interesting concept there.
So on that note, I think we trade in 3D. There you go.
Yeah, trade in 3D. My name's Charlie Burton.
My name's Ali Crooks.
Trade safely out there.